As part of his festive season cheer, Director of Investments at Sanlam SPI, Alwyn van Merwe gives investors his favourite stock picks for the year ahead. Investors would do well to heed his advice. The last 5 stock picks that he did a year ago yielded a whopping 45% between December 2011 and December last year. He joins us now from Cape Town to give us his top 5 picks for this year. Hi, Alwyn.
Good evening, Erki.
And you certainly had to remind us how successful those picks were. Just tell us what were the top, say, 3 picks for you for 2012 that did so well?
Quite frankly, I didn't even revisit what I said, but
yes.
You know, we picked some of the construction shares. So Wilson Bailey Home was certainly one of them. Old Mutual was also one of the shares that we have picked. So those were shares that people, I think, neglected the previous year, and we actually took the contrarian view, and they actually performed very well for us.
So looking at your picks this year, and Warren's going to ask you more detail, but looking at them, they're very diverse. So clearly there aren't any themes here, industry themes here. Is there some common thread, though, in terms of style of management, state of the balance sheet, prospects in Africa, etc.?
Erki, if you look at the stock picks that we put forward for 2013, for us, we simply look at the shares from a bottom-up perspective. So that is the first point. So you might not necessarily pick up a theme that runs through it. So that is the first point to make. Secondly, however, for us, valuation is quite important. So if you look at the picks for 2013, most of the picks that we've put forward, some of the stocks are actually not very fashionable. However, they show value, and it depends on the kind of value measure that you use, but more often than not we would use a price earnings multiple, and we use to do that we would look at normalized earnings to calculate the price earnings multiple. So I think that is quite important. And then maybe there is a third theme or a third point that I would like to highlight. You know, 1 or 2 of the counters that we've pulled out certainly are contrarian views. So those are shares that are certainly neglected by the market, and where the story at the moment is not one that the market would necessarily buy into. And maybe I must highlight it. You know, one of my colleagues picked Anglo Platinum, and given all the negative news flow that we've seen in Anglo Platinum, the share price took a massive hiding last year. But it seems to me that the platinum price is starting to stabilize, and even the share price, despite all the happenings within the particular counter, the share price appears to stabilize now. Although, you know, perhaps it is a share for investors with higher risk appetite.
Alwyn, I'm always intrigued to look at stock picks, and I know you've been through a couple of market cycles and you've seen the ups and the downs. Just to get this on record, you've gone with African Bank, Invicta, Steinhoff, Kagiso Media, and Pinnacle Technology. So 1 or 2 big companies there in African Bank and Steinhoff, and then a couple of the smaller ones, the smaller mid-cap shares. Let's go with African Bank first. Obviously, the credit bubble came to the fore last year in the media and in the news. What's your sort of take on African Bank, and by their own admission, the statement that they're actually trimming the amount of lending that they're doing at the moment?
Yes. Yeah, again, Warren, hi, good evening. You know, African Bank is a share that got hurt by the sentiment. There was a general view that there's a bubble in the unsecured lending market. We don't necessarily agree with that view. If you look at the unsecured lending, it's about 20% of the total lending extended in the economy. So that is the first point to make. We also think that the credit criteria, they've toughened up on the credit criteria, and therefore it might mean that the credit extended by African Bank, you know, that might slow down. Nevertheless, if you look at the valuation, and particularly if you look at the dividend yield, we think that the bad news is in the price. We also think that they've done a lot of work in Illerines over the last few years to set that company right. So the valuation, the negative sentiment at the moment, I think it's also an under-owned share, you know, for us makes it a stock pick for the year. I can also add Capitec. You know, there's not a lot to choose between Capitec and African Bank. I think with Capitec, perhaps a bit better provided. They don't have the Illerines arm. But, you know, that share is trading at a multiple, a discount to the market. and we reckon that Capitec will probably grow their earnings between 25 and 30%. So we don't think that it deserves to trade at a discount to the market. So I think, in fact, both of those shares, slightly different in nature, but in the micro lending space, and also, of course, cheap banking to clients, I think both of those shares deserve a place in the portfolio.
So just in terms of that answer, Alwyn, you've implied obviously that, fantastic from a valuation perspective, but from the perspective of being able to manage this credit bubble, if it is a credit bubble, you're comfortable that the industry is aware enough of the problem now that there's responsible action and reaction being taken place by the participants there?
Yeah, that is simply our view on the two major counters in the sector. You might find that other operators in that particular space, that they are less diligent in the work that they do and the credit standards. But as far as we are concerned, those two players have been are quite responsible, and we are quite comfortable, that they're well provided, and that the valuation at which you can pick up these shares justify the perceived risk by the market.
Alwyn, again, a big picture question about your 5 stock picks. No retail stocks, and you emphasised earlier about valuations being important, so I would imagine that's implicit in there. But also no mining stocks. Valuations, they look good, so here presumably it's about the prospects for the industry.
Yeah, maybe I should just comment on the retail stocks first. I made the point last year on this program as well. If you don't pick a particular share, it does not necessarily reflect a view on the quality of the company. And I think in South Africa we are blessed with very well run retail stocks, Shoprite being one of them. However, there comes a point where the market gets so excited about the quality of the company and the historic good record and track record that the company has set, that the market pays for these companies. And if you look at the price earnings multiples and the price to book multiples that the market was prepared, and dare I say, when I talk about the market, a lot of the investors, of course, came from offshore because they bought the broader theme, the consumer in South Africa and, of course, Africa, and they were prepared to pay these elevated multiples. So we decided to stay clear of those counters. And it just seems to me, if you look at the events so far this year, the weakness in the rand and a bit of negative political sentiment, that some of those foreign investors are starting to sell the shares, and I don't think the South African investors that stayed out of that sector will necessarily buy these shares at these levels. So we're quite comfortable to stay out of them. When we talk about the 5 stock picks, of course, you highlighted my particular stock picks. I've got colleagues as well in the office, and although it didn't make my top 5 list, it's certainly in the top 10. We have picked 1 or 2 mining shares. I commented on Amplats. The other mining share that features quite strongly in our portfolios is Billiton. And again, a contrarian view. If you look at the valuation of the counter, it trades at a multiple of about 11.7 times 1 year out. The trading update or the production update was released yesterday or the day before yesterday, and we had no negative surprises. In fact, there were some upside surprises. And I think their portfolio allows them a lot of flexibility. What I mean by that is they've got 3 major projects in the pipeline, but should the prospects for commodity prices change, they've got the flexibility to put it on ice. They've got a phenomenally strong balance sheet. So that is certainly a share that features quite prominently in our portfolios, although it didn't make my personal top 5, but it's in the SPI top 10.
Okay, so that's it for the mining. I'm intrigued just to learn a little bit more about some of these mid-cap shares you've also included in your portfolio. One of them's Kagiso Media. Just take us through that one. What's offering? What do you see in these media companies specifically?
Yeah, I just think again it's a valuation story. The share looks cheap to us. It just seems to us that the advertising revenue is starting to come through. If you put all of that together, I think it's also some of the small caps are neglected. We think that the earnings stream can come through for the company, and that is why we've included it in the portfolio.
And aside from Kagiso Media, the other one I wanted to find out about was Invicta. I understand this is an industrial company. I don't know too much about it, but perhaps you can just, for the benefit of myself, our viewers, tell us exactly what the company does, and then obviously reference why you find it attractive at this point.
Well, firstly, Warren, Invicta operates in the mining sector and, of course, in the agricultural sector, where they sell industrial equipment in those two industries. It is a company with a phenomenal track record. If you look at the return on equity, it is north of 30%. If you look at the track record, they've grown their earnings in the past at a much higher rate than the rest of the market. Admittedly, a lot of the growth that they've generated came from acquisitions, but the management team is quite focused. So I think the one thing that you can say about the management team is that they haven't overpaid for those acquisitions. So if you look at the valuation of the company, I think the company trades at a price earnings multiple of about 11 times. It is well entrenched in its market. And as I said, if you pay a multiple of about 11 times and you generate a return on equity of over 30%, I certainly think that that company justifies a place in the portfolio. It's unfortunately one of those companies that continues to do well. So, my natural style, or the natural style within SPI, is sometimes to be contrarian. In this case, we're not contrarian, but you've got to acknowledge that the management team has got a wonderful track record, and yet you don't overpay for the company.
You've touched on quite an important point there, and that's the way management teams allocate capital. And we've seen problems with Cynthia Carroll at Anglo American around some of the acquisitions and that might have led to a departure there. But how important is it when you look at a company to try and understand how well the management teams invest in acquisitions and other businesses and invest in their own businesses when you try and get a gauge for whether that share should be included in your portfolio?
It is very important for us. I think the general feeling within the team, and I know it's not a very popular view that some of the asset managers hold, but I tend to buy into it, is that quite often when you find the management team of operational companies, when they've got capital in hand, the CEOs are generally people who are quite optimistic and bullish, and they've got to justify their existence. So when they have got capital in hand, they will justify why they can spend it. On the other hand, we as analysts, although we only shift papers around on a desk, I think we are probably more sober, and I think we've got a better holistic view in terms of how capital can be allocated. So quite often you find, and particularly in mining companies, I think they were very guilty in the run-up when we had the commodity boom from 2003 until 2008. Many mining companies, I think, went into capital projects which they certainly couldn't justify on normalized commodity prices. It would have been better for those companies not to buy their own shares back, like Anglo's did, by the way, or to invest in some of the projects where they did. It would have been better for them to hand that capital back to the shareholders in the form of dividends, and we might well have been in a better position to allocate those capital to companies where the return on investment is much higher compared to what those mining companies did at that time. So it is something that we certainly look at, and it's a very important factor for us.
Alwyn, thanks very much.
You can see that it's a factor that the whole market looks at. Quite often when management now makes the comment that they will have a progressive dividend policy, you can see the market likes it, and quite often the rating of the share improves after that particular comment.